Hello, and thank you for joining us for the Argus Kepler Asia Crude Flows webinar today. I'm Tom Reed, VP of Crude and Refined Products for China at Argus. And leading our discussion today is Alex Booth, an old friend of mine and veritable sage of the oil markets, who is head of research at Kepler, one of the world's leading oil analytics and commodity tracking platforms. And we'll be hearing from Alex shortly before we move onto a panel discussion where we're joined by Leo Yang, General Manager of Trading at Unipec in Hong Kong, a titan of the oil trade, as well as other members of Kepler's research team, Kevin Wright, Lead Analyst in Singapore. So these are obviously tumultuous times for oil markets and indeed the world. Unprecedented is an overused term, but I think it's fair to say that oil markets have never experienced anything as traumatic as this, with economies in deep contraction, global oil demand tumbling over 8 million barrels a day from last year's levels, negative pricing for US crude in April, and of course, something that Kepler knows better than most, massive stock builds. And of course, it was to China, as during the last great price shock of 2016, that oil flowed, drawn there by very, very strong Chinese refining margins. And Alex will pick up the story from there in just a second, and we'll have a chance to thrash out some of the issues that he raises during our panel. And we'll try to cast the discussion forward a bit, peer into our crystal balls. We saw the IMF in June paint a relatively rosy picture of 5.5% growth in the global economy next year, something that would almost certainly cause higher oil demand. The IEA says oil consumption is going to rise by nearly 2 million barrels a day by December from the middle of the year. And OPEC Plus, the producer group, is of course for now sticking with plans to ease production cuts back in January that could inject an extra 2 million barrels a day into the market. But of course, the IMF's forecast was back in June. And if there's one thing that COVID-19 has taught us, it's that the virus moves faster than forecasters. Just this week, we've seen France and Italy return to full lockdown, with Germany and possibly the UK following suit. Total Chief Executive Patrick Pouyanné said just this week that he sees a far slower recovery to oil demand. And yet, we have not seen the kind of builds in North Sea floating storage that we saw in May. Instead, we've seen a lot of that clearing out to China. So I suppose one of the things that we could ask ourselves is whether the first half of 2021 will actually end up looking spookily like the first half of 2020. All things that I think we can profitably cover in today's discussion. But for now, no more from me. Let me hand over to Alex Booth. Alex, it would be great to see your slides.
Excellent, thank you, Tom. So I'll just start off with a quick introduction to Kepler for those of you who aren't aware of kind of who we are. We started back in 2014, pioneering the data intelligence and the commodity markets with LNG initially. Since then, we've expanded across all of the markets, moving into LPG, crude, refined products, and then more recently into dry bulks. We have over 5,000 users worldwide now, covering entities from kind of NOCs and IOCs through to trading houses and hedge funds. So all of this data is available through various means: our web app, the Kepler terminal, and then various kind of add-ins, APIs, etc. So as well as the data, we also have our research team. You said it's headed by myself, based in London, but we have a kind of a reach across the world with Kevin, who's joining us today, based out in Singapore, a couple of my colleagues in Paris, and then we have some folks in Houston as well. So that's kind of who Kepler is and who the research team is. So let's move on into kind of the main topic of today, and that's looking at initially kind of Chinese oil flows, what's been happening with the kind of the inventory situation, what's been happening with flows, and then also look a little bit broader into terms of how we've seen, as you mentioned earlier, kind of OPEC change their supply to market, and then also touch on some of the broader kind of global demand issues that we're seeing at the moment as well. So we'll start off with Chinese onshore crude inventories. We're kind of going to start high level before kind of drilling down in certain areas. So the slide here is looking at Chinese onshore crude inventories set against seaborne imports. So here we're looking at the kind of the waterborne flows, but then we're able to kind of to imply the seaborne demand from looking at the inventory changes against the kind of the net flows for China. And total seaborne crude imports hit kind of just under 12 million barrels, literally just touched under 12 million barrels back in June. And that's after touching a low of just under the 9 million barrels mark back in April. Now, despite that severe drop in imports in April, inventory still built at a very significant rate. So bottoming, implying very low demand, kind of seaborne demand, which bottomed out at kind of 7.5 million barrels a day back in March. So as imports have increased through the summer, we continue to see builds that imply that yes, refinery runs are improving significantly, but actually the kind of the apparent demand is still lower than you would kind of initially expect. So data so far through October points to a draw onshore, and we're looking at about 29.2 million barrels, just under the 30 million barrels mark as of today. Imports have dropped as well. So imports are averaging about 10.2 million barrels now, but because of that big drop in inventory levels, we are seeing actually kind of this implied seaborne demand increase significantly, actually up 760,000 barrels a day month on month. So if we move on to still kind of looking at China as a whole, but bringing some of the kind of the broader elements in that we've seen through the course of this year, and looking at floating storage. So this is crude floating storage, both at a global level and then a kind of the chart showing the subset that we see offshore Chinese waters. And that's also set against the 1 to 6 month Brent spread. Now, just to clarify, I've kind of inverted that on the chart so you can see how it essentially helps to kind of follow the pattern of the floating storage builds. So despite this record high import level, very high levels of crude buying in China led to this real significant increase in floating storage of Chinese waters. Now that, as well as this kind of rapid global onshore inventory builds, and then the kind of clear indication of a heavily oversupplied market back in the spring, essentially going into spring, really kind of pushed those Brent spreads into incredibly weak territory, which then incentivized that massive offshore kind of floating storage build as well. So with such strong incentives, we've seen global storage hit 218 million barrels kind of on the water by early July. So these volumes have subsequently cleared kind of on a global basis, but they've been quite stubborn off China. And it's only through the last month or so that we've actually seen the oil coming off the water in China, or kind of in Chinese waters. Now, what that's had a big impact on is congestion rates. So typical congestion delays for crude waiting for discharge into China averages around 4.5 days, basically. We saw that increase to kind of 12 and up to 14 days earlier on in the summer. That has now pulled back, but we're actually seeing a bit of an increase in the last few weeks, and that's kind of ticking back up to the 13 days level. So if we move on, look at kind of where is this crude being coming from, basically. Ultimately, kind of we've and how is it related to price action? And that's kind of where we're really interested. So what you can see on the slide here is Chinese destination loadings by origin for the United States and the North Sea. And we're also kind of bringing in the price action, looking at the Argus WTI FOB Houston price versus the North Sea dated crude. And what you can see is that despite TI kind of FOB Houston prices strengthening against North Sea dated during the period of the most extreme price weakness, so back in kind of the March, April, May contract or kind of trading period, flows from the US to China actually increased significantly compared, both on an absolute basis and also compared to North Sea dated, despite that kind of relative price strength. And what that's implying is that ultimately it's just the sheer availability of very weak, very cheap crude on an absolute basis that was really the kind of the primary driver. So after a decrease in these exports through the late summer, flows have picked up again from the US to China. And this is quite interesting. We've looked at this in kind of other kind of research pieces where looking at the kind of the total flow of commodities from the US to China has actually picked up, and it's kind of an attempt to look at the kind of address the phase one trade agreements. So we've actually seen a kind of, as we've worked through October, we've seen a kind of a bit of an uptick in what you see on the chart here from the North Sea, now to about 250,000 barrels a day. But we're going to stay on the crude imports and the kind of the price relationship, but kind of go to show how much flat price, how much kind of the absolute price of crude has a part to play in Chinese crude buying. So the slide that you see here and the chart that you see here has the Shandong crude oil imports against the Jano Des Shandong flat price. Now, it's worth clarifying a couple of things on the slide here, just kind of to show how you can kind of put this relationship together. And that's basically saying that there's a 2-month lag in the crude imports against the transaction date of crude, essentially taking into effect the kind of the transaction date versus the delivery date. And the crude flows have been inverted so that you can basically see how during the very weak flat price kind of trading environment in April of this year, the volumes that subsequently arrived were very high, essentially. So just a bit of clarifying there. So as you can see from the chart, there's kind of very, very marked impact on flat price or low flat price, and from the Des Shandong contract kind of into China. So over the last 2 years, Shandong imports have essentially followed the changes in these crude prices. And ultimately, the very low price that we saw transacted in April resulted in a much bigger kind of these massive imports that we saw back in June, which have then also stayed elevated. And you can see the kind of this partial recovery in flat price has led to a backing away of crude imports. But given where Des Shandong prices have transacted recently, we would expect, and kind of what we're seeing kind of materializes kind of a fairly stable continuation of flows at the level that we're showing there for the next couple of months, basically. So it's really just a way to kind of to highlight just how just that kind of really strong relationship, and which is no great surprise to anyone that's looking at the Chinese crude markets a lot. It's worth highlighting how there is still congestion in Shandong. It was a region that was particularly impacted at the peak of these delays back in August, when essentially we'd moved from a kind of a background level of 10 days delay in the congestion levels up to kind of quadrupling around the 40 days back in August. So the rates are normalizing now. They've normalized at quite a quick rate, but it just goes to show how much of a problem there was earlier in the summer. So if we stay with Shandong, but have a look a bit more at kind of what we can see in terms of where crude has been coming from. Shandong sources crude and kind of has the benefit of a very varied crude diet with oil from around the world. Basically, all of the major producing regions are shipping crude into the Shandong refining center. Now, the ramp up in June, or the June arrivals, particularly benefited Latin America, Northwest Europe, and the United States. So in that month alone, imports from Brazil totaled 928. In June, but kind of as we progress through the period, those regions have still benefited basically. So in September, imports from Brazil alone totaled 928,000 barrels a day, and those from the United States hit a high of 343 kbd in the month prior, so in August. So we find this kind of this flow from these alternative destinations, as it were, has continued. The regions also benefited very well from the growth of production in the Johan Sverdrup field in the North Sea from Equinor, with year-to-date flows averaging just over 150,000 barrels a day. Now, add in 4 cargoes of Grana back in August, and that put total imports from the North Sea at 417,000 barrels a day. So there's been this clear kind of will to import barrels, as I say, from across the world, basically. Now, I'm going to take a bit of a step kind of back from China, or kind of a bit of a step up, and look at the higher level now. And the chart here shows the global crude net exports against the constituent flow, so against the imports and the exports. And the point here is to really show just how extreme the situation was in terms of kind of market oversupply back in April of this year. And it's also worth kind of highlighting how the signals on the demand side were already there. We'd already seen the start of this steady decrease in demand, or kind of import flows, essentially, from COVID-19. The signs were already there. It's kind of well discussed at the time, but unfortunately, that essentially coincided with the gloves coming off with the OPEC Plus agreement between Saudi Arabia and Russia, essentially, with essentially production and exports in a free-for-all in April, and that gave us this absolutely huge overhang. Now, as big as the increase in exports was in April, the subsequent cuts in May were dramatic, basically, and we were able to swing the market, or the market was able to turn into a kind of a net import environment, and to steadily start taking this oil off the water. And that's proceeded all the way through to April now. So by the middle of September, we had essentially cleared the overhang that was created through kind of end of March and into April. So that oil had essentially come off the water. And in fact, the oil on water, so everything that's moving, everything that's waiting to discharge, everything that's kind of technically in floating storage, is now actually below kind of pre-COVID levels. So volumes averaged just over 1,100 million barrels through December and January, going into this year. We hit a peak at the beginning of May of just over 1,300 million barrels. And we're now sitting at just over 1,060 million barrels, basically. So we have had this kind of significant drawdown of crude, but it's taken a very long time to work through the problems that were created back in April. So kind of continuing on the theme of how we kind of got into the situation with this massive crude overhang, I thought it'd be interesting to look specifically here at OPEC, so not at the broader OPEC Plus agreement, and just it's a relatively simple way, but I think it's quite a strong way of showing just how we got to the situation where we were in April. Obviously, we had the OPEC agreement, or the OPEC Plus agreement, to limit supply, limit production back at the end of 2018. So this chart shows the cumulative KBD impact of that agreement on OPEC countries, basically, with regards to their net exports. So as you can see, over 16, 17 months from October, November of 2018, we were gradually taking away more and more crude from the market from OPEC Plus. Like the cumulative net impact loss was quite significant. It's getting down to about the 2 million barrel a day level by the time we hit kind of February of this year. However, the increase in exports that we saw in April effectively eradicated kind of 17 months worth of production and export cuts from the group. Now, as of May, essentially the cuts that were then subsequently made by Saudi Arabia and Iraq and Kuwait, particularly those kind of three countries, have had a very significant, kind of very marked effect. It's worth bearing in mind, though, that as we sit here kind of into October and moving into November, roughly half of the cumulative cuts that you see from this group are involuntary. Ultimately, they're coming from Iran, from Venezuela, and from Libya, where they have cut because of kind of various reasons, be it kind of political or internal civil war, have been unable to produce crude and export crude. Kind of a good example there, just looking at Libya in itself. So they've contributed 910,000 barrels a day of cumulative declines in exports since the end of 2018. Now, that's a country that has its kind of own domestic problems, but not those essentially enforced upon it by external sanctions. We're already seeing a significant increase in those exports as a ceasefire is kind of held in the country so far. Now, we've tracked, we're currently looking at tracking about 450, maybe up to 500,000 barrels a day of exports from Libya. Now, some of that is increased production, other of it is coming out of storage. But clearly that's a solid amount of oil effectively coming onto the market when we're really just in a situation where it's kind of the market is seriously questioning the demand going forwards, and that's what we'll touch on in the last slide, where we're looking specifically here at OECD Europe, because it's kind of a very interesting kind of region in terms of the impact of COVID and just how it has this real kind of counterpoint to the situation that you saw in China, and also across many other countries in Asia, essentially how they've managed to deal with the virus as opposed to say in the Western Hemisphere. So ultimately, European kind of crude imports have completely failed to recover. Through the third quarter of this year, volumes were still down just over 16% year on year, and that's despite a kind of a strong import month in September. If we take the inventory changes into account as well, we're again kind of looking at this implied waterborne demand in the region. Across Q3 again, that's still down 14%, 14.1% on last year. Now, all of the news at the moment, certainly in Europe, is kind of really heading in one direction with regards to the response to the virus. And I think this is what we're seeing really playing out in the kind of the fairly dramatic moves in not just the oil markets, but across kind of other asset classes, across like the equities markets as well. Basically, every European country is moving into more extreme measures, virus rates picking up. And it's hard to see basically how we're going to have any substantial change to this situation, at least in this region, until we get to the other side of winter and into spring of next year, essentially. So that covers all of the different subjects that I wanted to run through today. And now I'll hand back to Tom, who's going to moderate our panel discussion.
Thank you very much for that, Alex. That was extremely comprehensive, absolutely fascinating, and really great to see Kepler data being put to such expert use. I would like, I guess, to turn now, first of all, to Kevin, who joins us from Singapore. I think, one of the things that Alex mentioned was a pickup in the rate of US crude flows to China in response to the flat price. Obviously, we've got the US election coming up. I think that's something that we should maybe discuss, the rate at which those are likely to continue to grow. The other thing, of course, which we actually mentioned before this discussion started, was, of course, the closure of BP's Quinana refinery in Australia. They just announced that today. That obviously comes after a whole slew of refinery closures, windings down, running at reduced capacity across Asia. We've seen Batangas, Batam, Marsden Point. Obviously, I think it would be great if we could get some context on that from you, and then we'll come on to Leo for that discussion, maybe about the US-China trade flows. I think it would also be great to cover sweet-sour spreads in the context of what Alex was saying about reduced demand from OECD Europe, which has obviously hit demand for West African cargoes in particular. And then we've got Libya and OPEC. Let's start with you, Kevin. Give us your views on what exactly the closure of Quinana means for BP and I think for refining in Asia.
Thank you very much, Tom. It's a momentous decision, actually, to close Quinana. It's one of Australia's oldest refineries. It's one of Australia's largest refineries, around about 140-ish thousand barrels a day of throughput. And it's also incredibly strategically importantly located. It sits on the outskirts of Perth in Western Australia. It's in a very remote part of the world and of that island. And therefore closing that refinery shows you the pressure that refiners have come under. If you've got a refinery of such strategic importance and such isolation, with a market, next door in a very large metropolitan city in Perth itself, if that refinery can't stay open, that gives you a really clear signal of how much pressure refiners are under. Margins are terrible. I mean, we've seen gas oil cracks out here in Singapore this week hitting record lows. We're sort of talking $2 and below. And on that basis, when you think of the way that the Asian refining system is set up, i.e. to prioritize middle distillate production, that again just shows you how severe the pressure is. So the closure of Quinana is of massive importance to Western Australia and to the entire Australian petroleum industry, right? I mean, the Australian government has a stated aim in the last few years of achieving energy independence. So to suddenly reduce refining cover within the context of trying to increase independence, it really it's a fly in the ointment for the Australian government strategy. But it's, as I say, it's a sign of a wider malaise across the refining sector in Asia. You mentioned Shell in the Philippines closing, turning that into an import terminal because the economics for refining there don't make sense anymore. And again, it was a refinery that's next to a large metropolitan center. You've got a huge population, therefore you've got huge demand. So, when refineries like Quinana and Batangas are closing, it's a bad sign. We've seen it in the past. We saw a reduction, a rationalization program across the Med with refineries that were of a much smaller scale, and we're struggling to compete with the world scale refineries that we're seeing built in the likes of India, China, South Korea, etc. But yeah, I think it's a reflection of the pressure that refiners are under, and the only.
I think that. I'm sorry.
I was just going to say, I mean, the only way that refiners can stay competitive and stay profitable is through scale and technology, and that's where the Chinese investments have come in recent years. Enormous world-class and world-scale refineries that pump out super high-quality products. So it's your ultra-low sulfur diesels and it's your high-octane, low-sulfur gasolines, and that's the only way that refiners now can stay relevant. And that's not going away. And it's in a time of 20%-ish reduced demand, in terms of consumer consumption, then that pressure, that price pressure on margins becomes even more acute.
That actually, I mean, that is a very important point, and I wonder if I could bring Leo in on that. Obviously, next month, we believe the Chinese textile company Rongsheng is going to increase capacity of its ZPC refinery by 400,000 barrels a day. This is a huge company, makes most of its money from petrochemicals, reported record profits, I think, in the first 9 months of this year. Leo, how bad is this for refineries, just the sheer persistent growth in Chinese capacity at a time of very, very low margins? And is it sustainable?
Thank you, Tom. Sorry, guys, I was now right in the trading floor, so any background sound disturb you, please accept that as a live trading floor. Thanks, Tom, for the question. The Rongsheng, the second phase, actually giving big pressure for the refining section in the region, and I want to echo Kevin's topic as well. So it's not only that the overcapacity of a refining system in Asia, actually, aside from China itself, is already overcapacity. So we're talking Chinese demand. Actually, China last year China export 1 million barrels of products actually to the market, and now Chinese refining capacity is already over. And now the let's say is kind of productivity and the efficiency actually, and especially for this new refineries, there's Hengli and Rongsheng, giving more products flooding to the Asian market. I think the most hurtful could be Korea and maybe India, Reliance, and Australia as well. So in the future, probably such regions may receive maybe cheaper products from international market, maybe from China originally, maybe from Korea, but they don't need to refine. So this is about 3 to 5 years, and especially this Rongsheng now, and they will giving more products and more good products actually in the coming future. Actually, as of ourselves having a refining system as well, we also feeling pressures domestically. Tom.
That is, yeah, thank you for that very comprehensive answer, Leo. I think that really does just summarize, encapsulate very neatly the pressures that refiners are under. And of course, it kind of gives an expectation of product demand as well, with COVID persisting, deepening, worsening in Europe and the US during winter. I think for a lot of people, one of the things that they're going to be very interested in, of course, is that China continues to add this capacity, and it continues to draw huge amounts of crude its way. That trend is going to continue over winter because, of course, demand in the rest of the world is so weak. Leo, I'd like to come to you and then come back to Alex on that. Obviously, we saw U.S. crude flows to China hit record levels in September. Is that trend going to continue, Alex? And Leo, what's driving that? Is that pure economics, or is there a political dynamic to it? I mean, a lot of people talk about the Phase 1 trade deal, which kind of brings us neatly, I guess, back to the issue of the U.S. elections. Do you think U.S.-China trade flow is going to continue on crude? Is it purely economics?
That question is far beyond my control. But anyhow, the difficulties of diversify the supply to China is a question mark, and actually, people start to try to diversify the supply for whatever it's from. Well, once the U.S. shale oil pumped into the Gulf, actually, it was 2016 or 17, China or Unipec going to be the first company to bring this oil back to China. And you say economy basis, it could be, because if you don't have this, you need to come back to WAF or come back to North Sea anyhow. Well, the U.S. and China, I hardly answer because next week gonna be a big election coming, and I won't personally. I won't think it will change much, either Joe or Donald. So it's not between between the two countries.
Yeah. No, I mean, that's true. And of course, I mean, we've seen US-China trade flow pick up. We've seen UAE-China crude flow pick up. We see companies like Rongsheng open these big new naphtha-hungry refineries. Obviously, there's a demand for that light crude. Alex, what do you see as being the future, more short-term, I guess, than long-term, of those kind of flows?
I think to reiterate Leo's point around the outcome next week, we have the view that certainly when it comes to kind of US-Sino relationships, there's probably not going to be a huge amount changing, and it's kind of very much crystal ball territory. But from what you can kind of see so far, we think that there is still that kind of incentive to move products, and it's not just on the crude side; it's kind of LNG and LPG, the kind of the flows of commodities full stop from the US to China are significant. And just as I say, just when we thought that they had backed down again earlier on in the year, they've come back. So that will continue. In terms of the kind of the broader flows, again, you touched on it earlier, but one of the main or kind of a core demand area these days for products is in petrochemicals. Certainly not in jet. Transportation fuels are coming and going. Certainly, we saw a bit of a kind of a surprise downturn in demand at the moment in gasoline in the US as well. So petchems has really been the kind of the saving grace for demand for this year. And yeah, so ultimately that should continue. But the issue is, we're touching on with competition as well. It's not just kind of in Asia where you're seeing this growth in supply. It's also in the Middle East as well, where you have kind of at the start of next year, where due the new refinery, Jizan refinery in Saudi Arabia at some point, probably first half of the year. That's going to be supplying volumes into East Africa, which has typically been this kind of fantastic short for product from India as well. They're going to be looking for more competition. We've seen kind of this base flow or a stable flow from India and South Korea into East Africa for many years now. You open up Saudi refinery literally across the Red Sea. They're competing with the UAE. The UAE sent a record volume of product into East Africa in September, over 500,000 tons of clean products in September alone. So just this level of competition is going to be huge. From a broader flows point of view, I think one of the benefits was for the kind of the Chinese buying over the year is we're touching on the kind of the crude qualities and so on. It's US crude is a good crude to store essentially. It's kind of it fits well into nigh on any refining system essentially, and that's kind of I think that's one of the main factors behind the willingness to store US crude as well. As I say, Latin America has also benefited a lot. It's ultimately China is in a very strong position to be sourcing crude in a very advantageous way. Ultimately, yeah, I think it's going to be a very interesting one.
It is in a very advantageous position. Obviously, we're still, I guess, in a very depressed crude market environment. It kind of looks like a buyer's market. If you're a massive kind of net short like China, then obviously life does become slightly easier. The flip side of that, of course, is though, Leo and Kevin, that China's hunting to find new export outlets for its refined products. And as Alex was just saying, everyone's been kind of looking into that West African market. Nigeria, I think, plans to build its own refinery. How far afield do you think refiners, in particular in China, but also to an extent in India and the Middle East, are going to be able to send their product? At what rate is product flow globalizing, and what are the economics of long-haul product trade? Leo, do you have a view on that?
That's not my expertise anyhow, but I will share some information that I understand. As of Unipec, crude products team, sorry, they start long haul gas oil trading, the bring from Asia to Europe and Africa. I think 3 years ago, and now I think it is keep going for that. The problem is they need new ships, or the dirty vessel. Then they need to flood and then change to be clean. It's quite difficult. It's not a regular flow for sure, and they're waiting for new ships from Asia, and then can bring them back to Europe or Africa, and it's backhaul and loading the crude, which is a perfect backhaul economically for a logistic. But as of myself, I'm not expert on products, but actually, as we say, last questions, in Asia is becoming the world refining center. Apart from Europe, apart from US, actually now the refining capacity next year is, I think, 2 million barrels incremental, almost in Asia. And the other side is just the Shandong, the old and the refineries. So yeah, in the future, the flow will be reversed. So crude come to Asia and then products out of Asia, because as I said in the first question, it could be more productivity and efficiency, like more new refineries, high technologies, and especially for this pandemic. After this pandemic, I guess people will change their lifestyle, and EVs will come online, and people will more work from far away, not from office. So the overcapacity in Asia will still going on, and they need to bring these products to other areas. Tom.
Thank you very much, Leo. And I would love, first of all, to put that question to Kevin. How sustainable, how feasible do you see these long-haul product arbitrages? Do you think we can see a future in which China regularly becomes a supplier of diesel to Brazil, for example? And then I'd like to come back maybe to Alex and Leo and talk about what's going to happen next year with OPEC's easing of production restraints. Is OPEC banking on a big pickup in demand from China? Where else is demand going to come from? First of all, let's go to Kevin with that product flow question.
Leo's point is absolutely spot on. And even today, there was actually a report in another news source of a VLCC being fixed by Unipec. New build, so it's clean, and it's going from Asia across to the west. The intention is Europe, but obviously, as you head that way, you have a deviation point, and you end up going where the market sort of pays most for that product. And that's the only reason that it works. It's on huge ships that are new builds and therefore, are discounted versus market rates. Now, that's going to continue because that's going to become the cheapest source of diesel. And what it's actually going to do in the longer term is put even more pressure on refineries in the destination, in the demand centers. So I mentioned, in my previous comments that the Mediterranean had seen significant rationalization because of pressure from vessels arriving with diesel from the likes of Reliance, the likes of South Korea, etc. Well, if you're starting to see VLCCs of diesel turning up in the Med and in Northwest Europe, the pressure on the refining system there, which is, like I said earlier, not necessarily world scale or world class, that pressure continues to grow, and you'll see further rationalization of the refining industry in Europe. It's inevitable. I mean, it is it's an inescapable, inevitable trend now that, as Leo said, Asia is investing in these world-class and world-scale refineries and will become the world's refining center. And other refining centers, as we know them now, will cease to exist in the same way unless they have a niche in which to survive effectively. But you know, the investment going into refineries outside Asia is tiny, simply because it doesn't make sense.
And I guess one of the interesting things about that is that in the past, we've seen a sort of cyclicality of refinery investment. Is that now, that demand destruction we're looking at, that's not going to come back?
Yeah, I think, you know, the investment now going into refining outside Asia is tiny, because you know, these companies, I mean, if you look at BP, you look at Shell, they make far more money through investing in upstream activity than they do in downstream activity. And when you're looking at shareholder returns, and not just this year, because this year is obviously very peculiar, let's say, because of the pressures around demand and pressures on those companies. But the trend over the last several years has been to focus much more on upstream and much more on the gas side of the market. The returns from those activities are much higher than they are from refining, and so refining investment has gone down. It's become the preserve of companies that used to trade. You know, we've seen Vitol, Glencore, Trafigura, the biggest traders or the biggest independent traders, getting involved in the refining industry when the majors have pulled out. And that's, as I say, you know, the majors have a finite amount of capital effectively, so they've got to think about where to focus that. And the returns for the majors are much better upstream, and they're leaving the downstream activity to the independents. And that's changing the refining landscape.
Sorry, Alex.
Yeah, thanks. So I was just going to kind of add a illustration to Kevin's point there that we've seen kind of very recently in the Mediterranean with Saras Refinery. It's just a perfect example of, okay, it might be the very specific situation that we're in due to COVID. However, it's also hard to see as things progress how you can get out of it. And that's essentially, the refinery has furloughed, I think it's 1,400 employees, 1,400 workers through to the summer of next year already. And they were reporting that they were operating at rates that were essentially only high enough that they could keep the power plant running for the island. So that was kind of at least through into November. But we just have to see how it goes from there. So there's kind of very clearly kind of immediate, and then kind of as things progress, kind of potentially longer term impacts to see just kind of how this transpires, basically.
Yeah, no, absolutely fascinating. And I guess, you know, that kind of does bring us back to the issue of what demand is going to look like next year. Obviously, we have the OPEC plus agreement to cut output. That's going to be dialed back in January. Potentially, we're looking at another 2 million barrels of oil a day hitting the market. And of course, this is the time of year when refiners are in discussion with big OPEC members such as Aramco. I wonder if you could maybe, Alex, Leo, Kevin, each in turn maybe give us a view on whether that production easing is actually going to take place at this point, because things are looking pretty bleak for the oil market. Let's start with Alex.
Sure, thanks, Tom. I think it's a continuation of a long-held feeling that now that OPEC and OPEC Plus have gone down this path, even without COVID, it's very hard to get out of. To bring back production in any meaningful sense, I think is very difficult, even without the demand, the general demand pressures, or kind of the additional demand pressures, that we have now. You've essentially set the path for this being ad infinitum in my way. I don't see how, given that you have Libya that can come back anyway because their production is coming back, and that hasn't really been taken into account since the cuts. It's basically a gimme, and demand, I think, is going to struggle through into the spring still, certainly in the Western Hemisphere. I'm not sure when any of us are going to be getting on a plane in any meaningful sense, certainly in this region, and anytime soon. And any kind of positive price response is going to be met by US producers who've continued to maximize the efficiency in their operations, and so that they can come back. That's the thing; they will come back given a price incentive. So I think it's going to be very, very hard for them. You throw in the wild card that is the election. Again, we've kind of put a piece out yesterday looking at this, and as much as you can, I think whilst the US-China relationship, probably there's minimal change, the potential, and again, it's not very short term, but for the potential for a warming up of relationships between the US and Iran is non-zero. I think we could well see volumes coming back from there that aren't kind of taken into account in the overall agreement, because, as I said, was saying in the presentation, nearly half of the cuts, the cumulative cuts that you see today, are involuntary. So it's a very real chance that can come back. So I think it's very difficult going into next year to see a significant change from the OPEC Plus agreement, basically.
Yeah, Leo, is OPEC Plus pushing on a string?
I fully agree Alex's point, actually, because it's not only OPEC, it's also OPEC, non-OPEC, right? So the once Libya is coming back, so we don't know how OPEC is going to, I think at the end of the year, they're going to have another meeting for discussing next year's quota. But any easing, any easing actually will dump the oil price again. So, and now is totally a demand-dominated market. So because like last year, this year Q2, Q3, once OPEC had a meeting, nobody knows how this pandemic gonna last and how gonna act, giving any impact to this market. So now they realized, and they will definitely, if they will align with the pandemic ease. This is the condition, the conclusion for if they want to do it. And on the other side, non-OPEC, as Alex mentioned, once Biden had election, as they said, they will support clean energy. We don't know the shale gas, shale oil industry how it lasts. And once the oil price like 30, 35, and it won't support the, I guess, gas keep the production rate as of now. So, well, the conclusion, as mentioned, it will. I think OPEC going to be tamed, and looking forward to the pandemic very carefully.
Yeah, no, very hard for them to come back. Kevin, do you have anything to add on that front?
A couple of points, actually. The first of which is that OPEC has responded to the pandemic and the drop in demand in a really quite exemplary fashion, right? So we would see meetings between the OPEC ministers on a 6-monthly basis, making decisions about cuts and so on. And over the course of the pandemic, those meetings have become monthly. They're much more able to respond to changes in demand, and it is all about demand. And they're much more aware of the immediate impact of any sort of change in their own supply. Now, if you are one of the major sort of constituents, if you like, of OPEC, you're one of the Middle Eastern petrostates, you're absolutely dependent on revenues from your oil production. And that's about balancing domestic budgets. It's about, ensuring that your infrastructure projects carry on, that the promises that you've made to your populations are able to be upheld. So those states, the Saudis, the Kuwaitis, Iraq, etc., are so keenly aware of the importance of getting that decision right that they have to err on the side of caution. Because if they suddenly increase by 2 million barrels per day, as we're talking about from January onwards, the market will not be able to digest that crude and will fall into a situation again of effectively more surplus, right? Surplus on surplus. Well, that only does one thing to price. And as a result of what that will do to price, it hurts those petrostates. It hurts those nations that are so heavily dependent on revenues from crude. So, I can't see how they increase production. I think they have to maintain the current cut at 9.7 million barrels per day, because otherwise the damage they do to themselves is horrendous. It's horrific.
Thank you. Yeah, no, that's a very good point, actually, Kevin. And I wonder now if possibly to close off our discussion, we could bring it full circle back to where Alex started us, which is with the question of Chinese demand. Obviously, first half of 2020, China was there. It soaked up a lot of the global surplus. Chinese refining margins were extremely positive due to that country's price floor mechanism. Is that demand going to be there in the first half of 2021 when I think as we've discussed, it doesn't look like demand in the rest of the world is going to be there, even if supply remains constant. You know, that is still going to need to find somewhere to go. What does China look like in the first half of next year, Alex?
Let me just fish out the crystal ball. I think it's the answer. It's the question for everyone. I think from an anecdotal point of view, the Chinese economy is doing well. If we look at what's happening across the other commodities, if we look at kind of imports of iron ore, etc., it's performing well. Steel production, so on. The other kind of general economic indicators, are good. The question, I think, is how much can it continue to essentially be self-sustaining? So yes, I think petrochemical demand, global petrochemical demand, and therefore kind of petrochemical demand in East Asia and with a large amount in China will continue. But when it comes to the kind of the broader, how to phrase it, kind of not heavier industries, but when it comes to cars, to washing machines, durable goods, there we go. What's the appetite in the rest of the world as we move into next year? I think that's difficult to see. I think that's hard to see how it continues. I think I kind of tend to take this eternal bearish view in that it tempers the kind of my background with kind of optimistic traders versus kind of bearish analysts trying to kind of find some kind of middle ground. So I tend to have that dynamic as it is. But I think it's hard to see, and certainly sat here in Europe, it's hard to see how the rest of the world can support the Chinese economy and support Chinese demand. I think it has to continue doing it for itself, essentially.
Yeah, we've heard a lot, obviously, out of China, out of Beijing, from the plenum just this week about the dual circulation economy, about Chinese consumption, which grew quite strongly in the second quarter. Leo, how sustainable is Chinese oil demand growth? Are we going to see the kind of rates of increase that we've seen so far in 2020, looking ahead into 2021?
It's really hard to estimate, but currently the crude inventories and the products inventories are all in a historical high level. Yes, indeed, the Chinese economy could be the only positive one in this year, maybe quite good growth for the next year. The consumption side still have some problems, like domestic flights, of course, coming back almost 99%, but we don't have international flights. And as I said, actually some people's, they change their living style. People can work from home and not having this gasoline and the gas oil demand growing. And we see that the demand will keep grow, I think at least 5% comparing with this year. But it is a import. Maybe some of them in part of processing and re-export is not a pure Chinese demand. Once you see Chinese demand, we may more focusing on the consumption side, not import side, because most of them, I have seen most, but some of them have to be re-export to the internal market, like to Europe, Africa, or even to Latin America. And if it's maintained the region, the margins in the region are going to be very, very bad. And my personal estimate that next year's or even the year after next year's margins for refining section won't be fantastic. And the most, I think, attractive one, as Alex mentioned, would be petchem section. The petchem is already in a positive cycle. I think it will last us 3 to 5 years to produce the high end of petchem products will be preferred in the market. Tom.
Yeah, no, that's an incredibly comprehensive answer, Leo. Thank you very much. And yes, of course, we've seen this tremendous growth in petrochemical capacity in China. Who knows? I guess we could be heading the same way in petchems that we have been discussing. The refining sector has gone. But let's draw things to a close at end. Coming back to you guys, Kepler, the experts in the market. Obviously, we saw Chinese crude stocks balloon, as Leo was saying, during the summer. Is there much more capacity in that system? How much can Chinese tanks hold? How full are they now? You know, if the refinery demand is not there.
Thanks, Tom. So, well, we have, as mentioned earlier, we have seen draws through October. So as the imports have backed down, Chinese onshore inventories have also drawn about 30 million barrels through October. So there is the capacity there. It's we try and keep an eye on what's happening with the SPR facilities, because we still think that there is decent capacity within the kind of the government controlled facilities. But when it comes to the kind of the commercial operators, we've been at a stage for quite a few months now where it's very hard to put significant volumes into individual installations. Essentially, where there is volume, you have, I think we have a handful with between kind of 5 and a maximum of 20 million barrels. So I think it's excuse my horrendous pronunciation, but the Weifeng refinery still has about 20 million barrels or so, we think, in terms of capacity. But after that, you're looking at 5 or so million barrels here or there and another half a dozen. And then you move into a lot of smaller installation where there's kind of 1 million barrels here or there. And that gets very hard to fill. Basically, it's kind of from a logistics point of view, from an operational point of view, it's hard to top up the rest of those facilities. So we think that's essentially why you saw such congestion, because the infrastructure got to a point where it just couldn't cope onshoring all of those barrels, basically. And despite the record high imports that we saw earlier in the year, back in June, despite the volumes that they did manage to onshore, it gets harder and harder the more the system's full, basically.
Yeah, and I mean that is, you guys know this better than most, right? But we are, I guess, we see continued investment in Chinese infrastructure. Who knows? Maybe their capacity to absorb the world's surplus will grow, but I think, you know, as we've discussed today, it's unlikely to grow at the rate that the market in its present state of oversupply requires. I think that's probably all we've got time for today, but thank you all very much. Kepler, Alex, Kevin, you guys really leading the way, I think, in analysis there. Leo, thank you so much for joining us from Hong Kong during, I realize, what's a very busy time of the day. It's been great to get your opinions on the oil market. Guys, thanks very much. That's all from us, and we hope that you'll join us again in the future. Okay, thanks very much.